there's been a lot of growth in private credit in Australia. So, and that growth has come in a really short period of time. And anytime you see that kind of growth, you have to become wary in terms of making sure that those assets are actually allocated in optimal formats, consistent with what investors expect. And to some degree, I don't think that has happened. This is why you're seeing increasing kind of risk and headline risk around rising impairments in private credit. You also have issues around kind of exclusive private credit portfolios that have issues around transparency, around valuations. That is another theme that's starting to really percolate. And also liquidity is an issue in that market because you have certain structures out there that are offering kind of monthly or quarterly liquidity purely backed by liquid assets. So the extent that they can provide genuine liquidity to their investors, that is an issue which may or may not become a concern for investors. And finally, I think, and it's happening, it's starting to occur now and is likely to continue, is that you're going to be seeing, or you have been seeing, a lot of these kind of private debt positions being converted into equity positions, which is not something that investors actually bargained for to begin with when they went into these vehicles. So there is a place for private credit in Australia. I just think that it has grown way too quickly. I mean, we do private credit, but we do it in a format consistent with the multi-sector portfolios that we manage, which has a much wider opportunity set, much larger. An opportunity set where private credit plays a role, but it plays a role consistent with the size of the market that it should be.